going to discuss about chapter number 5 of our investment management. So chapter number 5 of our investment management is all about portfolio analysis. So what is the meaning of portfolio and what is the traditional approach and modern approach relating to this particular portfolio analysis? And then we will learn about the very important concept in this portfolio analysis, that is diversification. And then we will learn about the Harry Markovich portfolio theory. And then we will learn about the effect of combining the securities in a portfolio. And finally, we'll measure the expected return and risk of a portfolio with some few simple examples. So this will be our topic for discussion in this particular chapter number 5, portfolio analysis of investment decisions. Now, what is the meaning of a portfolio and how the portfolio has to be formed? I'll just brief you about what is the meaning of a portfolio. So, this portfolio in generic, where you might have heard about the word portfolio. So, a cabinet portfolio, whether a state government or a central government, they will have a portfolio of ministers. Now, what is this portfolio of ministers? There is a prime minister, and to the prime minister, in support to the activities of the prime minister, there will be a finance minister, there will be a revenue minister, there will be a defense minister, there will be a foreign affairs minister. Like that, there will be this group of ministers who are supporting the finance minister. We call it as the portfolio of ministers. So like that, we have portfolio. This word usually is used in many cases, but this word is more popular and very frequently is used with respect to the securities. Now, as we all know that when it comes to investment, investors have many investment alternatives. They can invest in shares, they can invest in gold, they can invest in real estate, they can invest in any other investment alternative. Now, when it comes to investing in shares, so here you can invest in either one share or you can invest in two shares. I mean to say that shares of one company, shares of two companies, shares of 3-4 companies. When you invest in the shares of 3-4-5 companies by not investing in only one company shares, it is called as forming a portfolio. To make it very clear with an example, I will tell you. Suppose if you invest in an IT stock called as TCS, all of the money, suppose you have an investment amount of 10 lakhs rupees with you. You want to make an investment with 10 lakhs. Suppose if you invest all that 10 lakhs in TCS shares, there is going to be some risk. How it will be risk for you? Suppose if something happens to the IT industry or if something happens to a TCS company itself, Tata Group, it's a very good group, we all know it, but if at all in worst cases something happens to the Tata Group, naturally what happens, the money of that, the share price of that particular Tata Group company will fall down. When the share price of that particular Tata Group company falls, all your investment will come down. You have invested 10 lakhs. The 10 lakhs may become 5 lakhs, 2 lakhs, 3 lakhs also it may happen. In the other way also it may happen. Suppose if TCS got some good project, American project or some other NASA project it has got. Now what happens with that particular project? There is a chance that TCS is going to earn higher profits in the future. So with that perception, people will start investing in the TCS shares. When the people have started investing in TCS shares, naturally what happens? The share price of that particular TCS company increases. Your investment of 10 lakhs will become 20 lakhs or it may become 25 lakhs also. So what I mean to tell here is, if you invest in only one particular stock, there is a higher amount of risk. It may happen in either way. Your profits may maximize or your money, that is the investment that you have made, it may come down drastically. So the risk of investing in one stock is very, very high. So what you can do to overcome from this type of risk? You diversify the investment. The meaning of diversifying the investment is, invest in TCS stock, invest in Tata Steel, invest in some other bank stock, invest in some other other type of metal stocks. So your 10 lakhs, now you are investing some part in TCS, some part in metal stocks, maybe some Tata Steel you are investing in Jindal Steel, you are investing in some other Wipro company, you are investing in some SBI bank, you are investing in some Reliance Industries. This is called as forming a portfolio. This is also called as diversification. Your investment, not investing in one particular script or one particular share, but rather you are investing in various shares of various industries of various companies. This is called as diversification. This is called as forming a portfolio. Now, how you have formed a portfolio? With 10 lakhs of your investment, you have shares of TCS, you have shares of Wipro, you have shares of Jindal Steel, you have shares of SBI, you have shares of some other Wipro company. This is called as forming a basket of securities. So your investment, as you are diversifying, you are forming a portfolio. Now, what is the advantage of forming a portfolio? All fine, we have seen that portfolio, how it is formed, that we have seen. Now, what is the advantage of forming the portfolio? Suppose in the first case, what we have discussed with respect to the example that we have learnt about TCS. If at all something happens to the TCS, all your investment will come down. Now, in this second case, when you formed a portfolio, if something happens even to the TCS also, you have not alone invested in TCS. You have invested in Wipro, you have invested in Jindal, you have invested in some SBI stock, you have invested in some other stock, Reliance Industries. Even if something happens to the TCS, your investment in with respect to the other stocks will not come down because they are all doing good. Only the TCS company is in problem. So what will happen is your risk will get minimized. Your return will get maximized. Your risk will get minimized and return will get maximized. This is the advantage of forming a portfolio. Okay, we have seen how a portfolio is formed with respect to the stocks. Suppose if you form a portfolio by investing in various investment alternatives, what is that advantage we will have? We will see now. Suppose let us take for example the 10 lakhs what you have with you, you invest in gold. So 3 lakhs you have invested in gold, 3 lakhs you have invested in stocks, 3 lakhs you have invested in some other investment alternatives like maybe bank deposits you have made, and some 1 lakh what you have kept as a liquid cash. So you for some contingency or for some other reason, you hold 1 lakh rupees cash. Now this is how you formed a portfolio with the 10 lakhs which is there with you. Now if at all some gold prices come down, there is no chance that the stock prices will also come down. So only the gold prices have come down. There might be some problem for 3 lakhs rupees that you have invested in gold. But with respect to the stocks, with respect to the bank deposits that you have made, there is no chance of coming down. So in fact, when you see in the reality how the prices of the stock and the shares will move is, if stock prices move up, the gold price comes down. If gold price move up, the stock price comes down. There is a negative relationship between the movement of the prices of stock and the gold. So if you form a portfolio with a gold, investment in stocks, investment in some other bank fixed deposits and holding the cash as a liquid asset, then if at all something happens to the stock market, if share price of stocks comes down, no problem with respect to the gold and other particular investment alternatives. So the risk will get minimized and returns will be maximized. That is called as forming a portfolio. Now, with respect to the portfolio analysis, this is very, very important. Now, which stocks has to form a basket for your portfolio? Now, you should now select, so which stocks I have to make as a portfolio? Now, I should go with only IT stocks. Now, I should see if at all you form a portfolio with only one company, one industry stocks, that is also a problem. So if you have in your portfolio IT stocks like TCS, Infosys, Wipro, and then Tech Mahindra, HCL. So if you have the stocks of only the IT companies, there is a problem. Why it is a problem? Even though you are making a diversification, if at all happens to an industry, overall to the industry, if some bad news comes, then these particular IT stocks will come down. So it is advisable when it comes to forming a portfolio, you should conduct some analysis. So what is that analysis we have to conduct is, suppose how the price of the stocks are moving. As I told you an example in the previous case, the price movements of these two investment alternatives, one is securities as well as the gold, it is opposite direction. If share prices comes down, if share price increases, gold price comes down. If share price decreases, gold price increases. So there is a opposite movement in the price of the stocks of the price of these particular two investment alternatives, that is stocks as well as the gold. Now when you make such type of analysis, you can take a very correct decisions with respect to in which an investment alternatives I can make a investment. So such type of analysis is called as a portfolio analysis. So portfolio analysis, if you make thoroughly, naturally you can do a very good investment, or you can form a very good portfolio by diversifying your investment. And the objective here, you should not forget, the objective of this portfolio analysis is you can see that the risk of your investment will come down, and at the same time the returns what you get, it will also get maximized. So that is in a brief about the portfolio analysis. Now we will see the subject concept that is given for us in this chapter. Now first we will learn about the traditional and modern methods of investment or investing in stocks. Basically traditional and modern methods of investing in stocks, how we have to make an investment to maximize the returns, that we will see. Traditional approach, how the earlier before, how the investors, what was their approach with respect to the investing in stocks is, they used to conduct a thorough analysis, fundamental analysis and technical analysis. Two types of analyzing the stocks we will see in this particular chapter. So fundamental analysis is you are going to study about the fundamentals of the company. So who is the promoters of the company, when it has started, how it is into which type of business, it comes under which industry, and also we will also study about the financial statements of the company thoroughly for the past 5 years, 10 years. How the company is performing. When you study all the aspects at 360 degree level, by considering all the aspects, then we say it is called as fundamental analysis. Now technical analysis is a type of analysis where we study the price movements of that particular stocks by the help of technical charts. So investors in the market, they may follow either of the two analysis. It may be fundamental analysis or it may be a technical analysis. Anyway, an investor in the market, before investing in any particular stock, he conducts fundamental analysis. Usually he conducts the fundamental analysis. So when he conducts the fundamental analysis, he will be knowing about how risky is the stock and what is the returns that he gets by investing in that particular stock. So this risk and return by investing on a particular stock, we will be knowing by conducting the analysis. And based on that, the investor, considering his risk appetite, the meaning of risk appetite is his risk taking ability. So he conducts fundamental and technical analysis for various stocks in the market, and then he will also assess what is his risk taking ability, and based on that he will choose in which stocks to invest and which stocks should not invest, and that is how he makes an investment, by following which type of approach? Traditional approach. So whereas a modern approach is quite different from a traditional approach, let us first now throw a light upon what is a traditional approach, and as per this traditional approach, how the investors take decisions while they are making investment. So portfolio analysis begins where security analysis ends. This is very important. So when you want to form a portfolio, what is that it is required? First of all, you need to know in that particular basket of portfolio what you are going to form, which securities has to get included. So that is the reason, what is that we need to do is, first you do the security analysis, after that you decide about with which securities I should form a portfolio. That comes later, comes what? The portfolio analysis. Now portfolio refers to investment in a group of securities rather than to invest in a single security. I briefed about you. So portfolio is investing in a group of securities rather than investing in one security. I also told you the advantage and disadvantage of it. So through which what happens is we can bring down the risk and at the same time returns will get maximized. Now, this is the famous quotation with respect to the portfolio analysis, which was given by Harry Markowitz. So, who is Harry Markowitz? He is the one who has proposed the modern portfolio theory. So, what he has told, don't put all your eggs in one basket. What is the meaning of this? So, we have a basket in which we put all the eggs while and we plan to carry it from a place to place. What will happen if you do that? Now, we have a basket, in that we placed all the eggs. The idea here is we want to take that basket from a place to place. If at all something happens to that particular basket during the transit, all the eggs in that particular basket will get damaged. So here we need to compare the eggs with the securities. What's the meaning of here? So do not put all your investment in one security. Why we should not do that? If something happened to that particular industry or to that particular security, naturally what happens is prices comes down. As a result, all of your money what you have invested, it also comes down. That's the reason we need to make a diversification. Invest some part of your total investment in one security, other part in other security, other part in other security, other part in other investment alternative. This is called as forming a diversification. If you diversify your investment, no matter what happens to one security, other investment alternatives might be doing well, thereby your returns will get maximized and your risk will be minimized. This is the idea behind this particular great sentence which was given by Harry Markowitz, right? So, portfolio analysis is the determination of the future risk and return in holding various combination of individual securities. Now, this is very important. So, here various combinations is very important. So, it is determination of future and risk and return in holding various combination of individual securities. Here different combinations. Now, it is very important that we will learn under modern portfolio approach. Now, which securities to combine, which securities should not be combined. Now, I told you that when you are forming a portfolio, don't choose one industry stocks to form a portfolio. Why? Because if at all something bad news comes out of that particular industry, all the stock prices through which you have formed a portfolio, its prices comes down and the value of that particular your investment will also comes down. That is the problem. So what is that you have to do is you need to make an assessment of which is the better combination of the securities which I need to form a portfolio. Okay, so through these particular better combination, what happens? The overall risk of the investment will come down and the return will get maximized. Risk will come down and the return will get maximized. This is the objective behind forming a portfolio. Now, portfolio analysis helps to make the investment activity more rewarding and less risky. This is the ultimate objective of portfolio analysis. So, portfolio analysis main objective is to make the investment is more rewarding and also less risky.